Welcome back to this week's market update. Today is February 10th, 2025, the day after the Super Bowl. Congratulations to the Philadelphia Eagles. And with that, we will jump right into this week's market news. Stocks started last week more positively, you can see right here, but then fell sharply on Friday, responding to the weaker than expected payroll growth as well as a weaker than expected consumer sentiment reading, highlighting consumer concerns over inflation related to tariffs. As of Friday, February 7th, the S&P 500 fell just about 0.25%, while the Dow and the Nasdaq both fell a little bit more than 0.5%, followed by the Barclays Aggregate Bond Index, which was just slightly positive, up 0.06% for the week. Shifting gears into our economic news from last week, perhaps the largest piece of news was the January employment report. So this was a big one here. You could see the unemployment rate actually fell. It fell to 4%. So again, a very healthy level of unemployment, but the number of job gains was lower than expected here. So we saw non-farm payrolls rise by just 143,000 compared to the 170,000 that were expected. We saw job gains concentrated in healthcare, retail trade, government, and social assistance, while most other industries, a lot of cyclical industries like construction, business services, saw very little change. Wage growth, on the other hand, surprised to the upside. It was up 0.5% in the month, and wage growth was up 4.1% from a year ago. So we are seeing some real wage gains above the inflation rate. Overall, we saw a pretty stable labor market in the month of January with the unemployment rate dropping off, but this weaker than expected job growth did concern some investors on Friday last week. Adding to the negative momentum on Friday, we had the Consumer Sentiment Index, which came in lower than expected from the University of Michigan for the month of February. Sentiment fell 4.6% from January and 11.8% year over year, marking its lowest reading since July 2024. We saw that the decline was pretty broad-based across several political groups, across all political groups, as well as across diverse age and wealth demographics. The main reason behind this drop in sentiment was a rise in inflation expectations following tariff developments. So you can see here, post-election in December, Trump continued to reaffirm his plans when he was inaugurated to hike tariffs. You can see that caused inflation expectations to rise. And then on January 31st and then on February 1st, Trump announced tariffs on China, Mexico, and Canada. So that led to this more recent increase in inflation expectations there. Currently, only 10% tariff on imports from China is active, while the tariffs on Mexico and Canada seem to be paused as the countries work out some negotiations. So pretty interesting here. Overall, we do tend to see tariffs become inflationary for consumers if they are extreme and held for a period of time. However, if these tariffs are more of a bargaining tool used as a short-term tactic while President Trump negotiates with other countries on trade concerns, it may have a very limited impact on inflation. So we'll just have to see what the net result is. But as of now, the tariffs seem to be spiking inflation expectations for consumers. Moving along with some other data from last week, we did get the ISM Manufacturing Index for the month of January. It actually turned positive for the first time after 26 consecutive months of contraction, with January's Purchasing Managers Index here rising to 50.9. Within the index, we saw things like employment that improved quite a bit here, new orders that also improved quite a bit in the month, as well as production and prices. That was a positive contributor to the ISM Manufacturing Index, showing some activity, but it does also hint at some possible inflationary pressure there. So overall, this is a positive month of the ISM Manufacturing Index after many, many months of contraction in the sector. So a good sign there, but we'll have to wait and see if this is just 1 month of an anomaly or if it continues to trend up. Along with the ISM Manufacturing Index, we also got the Services Index showing at 52.8% in the month of January. So another positive month there. It's actually the 7th consecutive month of growth following 53 months of expansion out of the last 56 months. So a pretty long-standing positive trend in the service side of the economy. So this is a good sign when we have both the ISM manufacturing and services indexes both positive. That tends to be correlated with strong economic growth. So we'll have to watch and see if the manufacturing index's month of positive readings there was an anomaly or if it is a more longer term trend forming before us here. Last but not least, doing a brief check-in here on where we are in Q4 earnings season. We have about 60% of the S&P 500 reported at an annual earnings growth rate of 16.4% when you take the companies that have reported and blend them with the remaining estimates for companies that have not reported yet. So that's a pretty strong number there. You can see much higher than the 11.8% that was expected as of year end going into the year. We also saw revenue growth up to about 5.2%, blending estimates with actual numbers, while the original estimate was for about 4.6% sales growth. So both stronger than expected on sales and earnings. Then when we break it down by a little bit more sector specific, we can see financials, they have been better than expected, and they've also been the leading category of year-over-year earnings growth, followed by communication services and consumer discretionary. So all three of these tend to be more cyclical businesses. So when we see those leading the S&P 500 in earnings growth, that tends to be a positive sign that the economy is growing from these very healthy things like banking services, communication services, and consumer discretionary. So that's overall a pretty good sign for these sectors individually as well as for the economy as a whole. That concludes this week's market update. We hope you enjoyed, and we look forward to seeing you again next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.